CIBC, BMO and TD all beating earnings expectations in their latest quarter and increasing their dividends. Let's get more from Mike Clare, Senior VP and Senior Portfolio Manager at Brompton Funds. Just the person to crunch these numbers. Mike, thanks very much for joining us. Before we get into the individual banks, are you seeing any themes emerge this earnings season?
Yeah, we're seeing a few consistent themes across bank reporting. Like, first of all, it's been a fantastic quarter across the group for all six banks. One of the key themes we're seeing, of course, is capital markets revenues have been very strong across the group. This is a theme we've been pushing on really since the beginning of this year, or late last year. Trading businesses were really doing well early in the year, and they continue to do well, driven by the volatility we've seen in the market, and that sparks more client activity and better trading volumes and better trading revenues for the banks. But lately, we've also seen an uptick in investment banking revenues, which is something we've been expecting to come for some time now, and that should continue into 2026, just on a favorable environment for deal making, particularly in the U.S., where we see regulatory relief driving M&A activities, new equity issuance, and the like. So some of these key themes really driving strong performance for the banks here.
Tell us what jumped out for you at these CIBC results. The bank's been on a roll over the past couple of years in terms of exceeding expectations.
Yeah, so I mean, what jumps out for me really is nothing really jumps out too much, and that's a good thing for CIBC. I think they've done a really good job over the past couple of years driving like a steady business, focusing on the mass affluent customer in Canada, and that's really driven some more steadiness in their results. Of course, we saw strong capital markets revenue from CIBC, and their U.S. business is doing really well too. If you look at U.S. commercial banking and wealth management, up close to 40% year over year. And then in terms of like the credit market environment, so like obviously credit like provisions have been elevated across the banks, including for CIBC over the past year, a couple of years. We're starting to see some moderation there. So, we expect, credit provisions to remain somewhat elevated but manageable for a bank like CIBC. We saw in the current quarter, impaired provisions are roughly in line with estimates, performing provisions, which is, looking at the potential for loans to go arrears in the future, uptick a little bit slightly. I think they're being a little bit conservative there just on the macro environment. So nothing stands out too much for us on CIBC. It's steady as she goes. We like the bank, and they're performing well across all their business units.
Bank of Montreal. Now, correct me if I'm wrong, but there was some concern about credit risk in the U.S. operations. Is that dissipating?
Yeah, that is definitely dissipating. We've seen going back a few quarters, BMO had some issues with credit provisions, particularly coming out of the U.S. bank. That really has started to moderate now. We saw, for example, in the U.S., just looking at impaired loans actually starting to move lower, impaired loan credit losses starting to move lower. And that's definitely a positive for BMO, particularly relative to expectations.
And the dramatic story, of course, TD. Investors hoping that they can put these U.S. troubles behind them. Anything interesting there?
Yeah, I think actually the TD's done a really good job putting some of these U.S. issues behind them. So two things going on with their anti-money laundering remediation program. Of course, they had the asset cap in the U.S. where it was last October, just over a year ago, regulators forced a cap on that business in terms of asset size. Of course, the bank doesn't want to operate right at that cap, so they've spent the last year right-sizing the balance sheet. So they've reduced the U.S. balance sheet by about 10%. That's now complete, so they can drive some business growth there going forward, focus on key customers. And then on the AML side, they're still talking about spending $500 million a year on their remediation program. That's not a surprise, but things are going well there. But this is ultimately something that's going to take another 2 or 3 years to resolve.
What bank stocks do you think offer the best prospects right now, Mike? Say if one had a 5-year time horizon and was looking for total return, dividend plus stock appreciation.
Yeah, I still think, I've talked about it in the past, I think Royal Bank is the best operated bank in Canada. Things continue to go really well there across a number of their business lines. And notably, it tends to trade at a premium to the group, but actually that premium has come down versus the group. So we think it's a good opportunity to pick up RBC shares. And we also like TD. The other thing that's going on at TD is they've got a cost restructuring program in place. So they've actually expanded that program. So they're spending about, in total, $825 million in restructuring costs up front, essentially to drive ultimately $750 million in annual cost savings. And that's something that could really drive growth in EPS and improvement in ROE closer to their 16% target. So we like both of those banks in particular. So
TD is spending more than $700 million to cut costs. Is that partly severance or? Yeah, so it's partly severance. They've talked about a 3% headcount reduction. They're also right-sizing the branch network, closing some branches, right-sizing their real estate portfolio, closing some smaller business activities, things like that. So it's various restructuring expenses that go into that, and then that should drive pretty substantial savings on an ongoing basis going forward. Mike, before we let you go, Laurentian Bank finally coming off the public markets, but National Bank finessing it, not taking on the liability of a branch structure. That's just going to be chainsawed, it sounds like. What did you think? Is National Bank getting a good deal there? Yeah, I think that looks like a pretty good deal for National Bank, just picking up some balance sheet growth, both on the asset side and the deposit side, without the need for costs in terms of the branch network and people. So it's something we think they can integrate pretty well into the business, and it is definitely a good deal for them.